An accounts receivable occurs when a company completes a service or sells a product before the payment is made. These receivables are considered current assets in the balance sheet. Emmanuel's bookkeeping expected $1,333, but only received $1,000. This is known in accounting as uncollectible receivables, and due to its commonality, there must be a way for this to be accounted for in the accounting statements. Otherwise, the accounts receivable on the balance sheet will not be a truly faithful representation of the company's financial strength and may cause bad decisions in the future. There are two ways to account for uncollectible receivables. These are the direct write-off method and the allowance method. While both methods record the inability to collect these receivables as bad debt expense, the way in which they operate is fundamentally different. The direct write-off method is recorded when it is evident the receivable is uncollectible. In the example shown before, this time was 270 days. The main advantage of the direct write-off method is its simplicity and thus low cost. However, due to the time needed before being able to write off a receivable, in this case, 270 days, it can often violate the accounting principle of matching, with the revenues and expenses being recognized very far apart. Further, when using this method, the company's assets would still be overvalued by $333.33 until February 2020. The second method, that is, the allowance method, attempts to match the expense from the uncollectible receivable with the time period in which it was created. This creates a problem on the micro scale, as the company cannot deduce exactly which receivables are uncollectible at this stage in time. Thus, the company creates a contra asset account called allowance for bad debt, which is the balance in dollars the company believes it will not receive. This can be shown in Emmanuel's bookkeeping. In the allowance method, there are three ways of calculating your allowance for bad debt. These are percentage of receivables, percentage of sales, and aging of accounts receivables. These all have advantages and disadvantages related to the way in which they operate. In conclusion, the need to account for receivables is of the utmost importance when attempting to highlight the financial position of a company. Without accounting for these uncollectibles, a company will most likely make decisions from a false sense of financial security, greatly limiting its chance at success.